Thanks for tuning in to the Signature FD weekly investment audiocast that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD. So we're going to start this week with our chart of the week, and we call this one Earnings Season Margins Watch. So the earnings season for the second quarter gets underway here with the large banks this week. The Q1 earnings season was quite strong, and a lot of what drove the strength in the first quarter was companies really did a great job preserving their profit margins. And so that's what this chart is showing is three different profit margin metrics, and you can see that all of them have been hooking higher, and gross margins in the top clip are not that far off from their all-time high. Now, with tariffs and potential inflationary pressures from that, it'll be interesting here in the second quarter to see if companies continued that trend of actually expanding margins, or if there starts to become some margin pressure out there. It would be quite a bullish case if margins continued to remain steady or even expanded. And we might take that as a little bit of a deterioration in fundamentals if margins start to contract a bit. So that's going to be something to watch here as the Q2 earnings season gets going. Now, when we look at returns year to date, we can see that most major asset classes are positive for this year. Almost incredibly so when you consider that the S&P 500 had about a 19% pullback in the first quarter until April 8th. When we look at leadership trends this year, though, we clearly see leadership from the international markets. So, developed international markets are up almost 20% this year, and emerging international markets are up over 16% this year. Now, there has been strength in their underlying stock markets, but also they've received a tailwind from a weakening US dollar. And that's what you can see here in the green line is the US dollar is down almost 10% year to date, and that has continued to be a tailwind for the international markets. Now, when we think about economic data, we got some more jobs data last week, and one of the pieces of data was the Conference Board's Employment Trends Index. And that's what we're showing here in red in the bottom clip. And we can see that there's been a fairly steady deterioration in this index since 2022. There was a little bit of an uptick going into the end of the year last year, but it's again resumed its decline. And what this is telling us is that the employment trends out there are softening, and that does tend to be a leading indicator for actual job creation or non-farm payrolls in the top clip. So you can see that this indicator did generate a bearish signal for non-farm payrolls. Now, non-farm payrolls have been able to buck the trend for the last couple years, but we have seen continued moderation in the labor market, and that's something to watch. And that's especially true when we couple it up with what we're seeing in continuing jobless claims. So initial jobless claims are pretty flat for the year, but we have noticed over the last couple months a breakout in continuing claims for unemployment insurance. So that means that people aren't losing jobs at a greater rate, but when they do lose jobs, they're having a more difficult time in finding a new job. So we can see that continuing claims have broken out and are now up over 6% on the year to date number. So that is also something to watch. Now, what's going on with the labor market? One of the things is small business optimism has been easing, and we need to remember that small businesses are still a massive job creator in this economy. What we can see here in red is we can actually see small business hiring plans, and it's inverted. So when that series is rising, that means that small businesses are planning on doing less hiring. And you can see that there's a very tight correlation with the unemployment rate between small business hiring plans and then again that unemployment rate. So we do expect that easing small business optimism should continue to put some downside pressure on the labor market. Now, why are small businesses starting to become a little more pessimistic? And it's really owing to the inflationary impacts. So they are potentially more economically sensitive businesses and among the first to feel the impacts from inflationary pressures from tariffs. Now, when we look at home builder confidence, that's another series that has been weakening this year, and that's the blue line here on this chart is home builder confidence. And that has a tight correlation with housing starts. So we do expect housing starts to continue to slow as well. There's actually almost 10 months available supply right now of new homes that are existing to be purchased. That's a high level. So there's a lot of inventory that has been built from a new homes perspective. And what the thing to watch here is if home builders begin to pull back on their building activity, then you could see residential construction employment start to weaken. And that has been a reliable leading indicator of economic growth and the job market at large. Now, despite year to date weakness, the dollar does remain overbought. So, we mentioned here at the beginning of this presentation that the weaker dollar has been a tailwind for international stocks. And we suspect that the dollar could continue to weaken just because it had gotten so stretched versus other currencies. So, that's all we're showing in this chart here. The blue line in the top is the US dollar index. That dashed orange line is the trend of the long term trend of the dollar. And then we compare the dollar to its long term trend in orange, the solid line in the bottom. And you can see that the US dollar does remain overdone relative to its historical trend. Historically, when the dollar has gotten this overbought, the dollar has tended to be weak over the next 1, 3, 5, and 10 years. So this could be potentially a structural tailwind for international stocks relative to US stocks. Now, when we think about the technical trends in the market, we would classify the technicals as solid but not spectacular. So here we're showing in orange, we're showing the percentage of all small cap, mid cap, and large cap stocks that are trading above their respective 200-day average prices. And that is at a level of 60%, which is relatively healthy, but not as strong as some of the readings in very long, prolonged bull markets that we've seen before, where you can get upwards of 80, 90% of issues above their longer term trend. So 60% solid, but not spectacular. And that's kind of how we would classify the trend evidence today. Now, as we look ahead to Q3, we do expect that there could be some corrective action in the quarter. So here we're showing in blue the average of the S&P 500 in all post-election years going back to 1928. And you can see that in post-election years, the middle portion of the year does tend to be pretty strong, the second quarter especially. And just like years before, we have seen a strong second quarter. But if you look at the trend as you start to roll into August, historically, the market has gotten into a little bit of trouble in the third quarter of a post election year. So that's something to monitor going forward. Is the market going to follow suit with seasonal tendencies and correct in the third quarter? Now, we do expect any correction to be limited to just that, a correction, and not an outright bear market, as long as you have improvements in the corporate fundamentals. So Q2 earnings season is going to be important. So for some closing thoughts, earnings season does kick off this week with the big banks. The ability for these companies to preserve their profit margins, that's going to be important and something to watch, and seeing how much tariffs are impacting the actual margins for businesses. Now, most major asset classes are positive year to date, but there is a notable exception of the US dollar. The US dollar has been weak, and that has given international stocks a further boost. Now, there are some cracks from a macro perspective that are forming in the labor market owing to weak small business and home builder confidence. For now, we would call them just cracks, not an imminent recession, but this is something to watch. Now, market breadth from a technical perspective is solid but not spectacular. We would like to see further broadening in this uptrend to have more confidence in the longevity of the bull market. A third quarter correction would be consistent with prior post election year tendencies, but a bear market does remain unlikely as long as those corporate fundamentals continue to improve. That's what we have for you this week. As always, thanks for joining us and have a terrific week ahead.